Bismillahirrahmanirrahim. This is the second video on federal government accounting and reporting. In this video, we will solve an exercise on journalizing budgetary and proprietary transactions of a federal agency. We will post the journal entries in the ledger and prepare pre-closing trial balance. Then we will explain how to record budgetary and proprietary closing entries. And finally, we will prepare the balance sheet. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video help fresh graduates who have joined the governmental or not-for-profit organization and want to refresh their learning on federal government accounting and reporting. A very special word of thanks to Nabia Khan, who spared at least 3 days of her vacation to meticulously put the information in the PowerPoint. So let us start with the basic journal entries of a federal government. So this is the summary of the journal entries of a federal government. You can see that only budgetary journal entries are recorded when OMB apportions, when department allots, or agency commits, or when the agency obligates. At the same time, no budgetary journal entries are recorded when the agency asks Treasury to make payment or when the agency uses goods or equipment. So let us solve an illustration on federal government budgetary and proprietary transactions. The Agency of Bureau of Food Inspection is a unit of the Federal Inspection Department. The agency was created in September 2022 and that it had received a startup appropriation to purchase inspection equipment. As a result, the agency's balance sheet at the start of the fiscal year beginning October 1 showed an asset captioned General Property, Plant and Equipment and a net position item captioned Cumulative Results of Operations, each for $40,000. The following transactions took place during the year. The first one is the authority to spend. So the accounting and the first transaction is at the start of the fiscal year the Congress made and the President approves an appropriation of 150,000. So the accounting cycle begins at the start of the fiscal year, and when the President approves an appropriation, then the budgetary entry is made. As you can see over here, we make a budgetary entry, and the budgetary entry is other appropriations realized debit and unapportioned authority credit to record receipt of appropriation authority. So in this case, it is the same journal entry, other appropriations realized debit, unapportioned authority credit for 150,000. You can also see that we will also record the proprietary entry and this entry establishes the accountability for the appropriation, while the credit to unexpended appropriation received increases the agency's net position. So you can see over here again we have made the proprietary journal entry as well. Fund balance with treasury is debit and unexpended appropriation received is credit. Just keep one thing in mind that this increases the agency's net position. Okay. We move on to transaction number B. The entire appropriation is apportioned by OMB. So when the OMB apportions, we make the budgetary entry, and that is unapportioned authority debit and apportionments credit. There is no proprietary journal entry at the time of apportions by the OMB. So we have again the unapportioned authority debit by 150 and apportionment is credit by 150, and there is no proprietary entry. Then number C, the administrating department decides to make quarterly allotments to the agency. For simplicity, it is assumed that the department allots the entire 150,000 to the agency. So when they are going to allot, the general entry is apportionment debit and allotment realized resources is credit, and there is no proprietary entry. So you can see over here budgetary general entry is apportionments debit and allotments realized resources is credit by 150,000, and there is no proprietary general entry. Next, let us discuss how to record transactions for acquisition and use of materials. So that will be transaction number 2 over here, and you can see that the agency has to record several general entries on acquisition and use of material. They have to record the budgetary entries, and these budgetary entries help to keep track of the resources available for spending. So look at the first transaction. The food inspector requires materials and the purchasing department estimates that the cost will be 40,000. So the agency use commitment accounting for budgetary control purposes. You can see over here. This helps the agency to reserve the amount from allotment before purchase order is made. So the first budgetary entry is to record the commitment in order to reduce the amount available for spending. You can see that at this stage there is no proprietary entry, as the agency wants to only make a commitment. Let us move to transaction number B. Now an agency uh, a contract is signed for a contract is signed for 42,000. Now a agency can purchase through contracts only, and once a contract is signed with the supplier, it becomes a binding agreement. At this stage, commitment becomes an obligation. You can see over here, commitment becomes a obligation. So it is possible that the contract amount agreed may be more or less than the committed amount. So the accountant must adjust the allotment amount accordingly. As you can see in this transaction, the amount committed was 40,000, while the agreed amount as per the contract is 42,000. So the difference of 2,000 is adjusted by debiting the allotment. You can see that there will be no proprietary journal entry, as still the supplies are not delivered. So let us move on to transaction number C. Now, delivery of order is accepted. So once the material arrives and accepted by the agency, the budgetary entry is to debit undelivered orders, obligations unpaid, debit, and we credit delivered orders, obligations unpaid, uh, credit. You can see that because undelivered orders, obligations unpaid is debit, and delivered orders, obligation unpaid is credit, to record acceptance of delivery. Now, since the material has arrived and accepted, you can see over here arrived and accepted. Now, the financial accounting, that is proprietary entry, is also going to be recorded, and it is going to record the asset and the liability. So, you can see that the proprietary journal entry is operating materials and supplies held for use is debit, and accounts payable is credit by 42,000 to record acceptance of material. At this time, we will also record the appropriations used to acquire the asset by crediting the expended appropriations and debiting unexpended appropriations used. So we have the general entry here to record financing of materials purchased. Next, the agency notifies the treasury for payment. So, two journal entries are recorded regarding payment of accounts payable. First, the proprietary journal entry is made when the agency sends a disbursement schedule request to the treasury. You can see that there is no budgetary entry, and the proprietary entry is accounts payable debit and disbursements in transit credit, to record request to treasury for check. The second journal entry is made you can see when the agency receives notification from the treasury that the payment has been made. So at this stage, budgetary and proprietary journal entries are made simultaneously. The budgetary entry is made as payment changes the budgetary status of the event from an unpaid obligation to a paid obligation. And the budgetary journal entry is delivered orders, obligations unpaid debit, and delivered orders, obligation paid is credit by 40,000 to record the payment is confirmed by the treasury. The proprietary journal entry to confirm payment will be disbursement in transit debit and fund balance with treasury credit by 42,000. You can see that, okay, so that is number G, and we move on to number F. Now, for transaction number F, the agency uses 35,000 of supplies. So there will be no budgetary entry. Now, as we have already recorded the budgetary resources, you can see over here we have already recorded them. However, since the federal government uses the accrual basis of accounting for proprietary accounts, so we will record the use of supplies. You can see that there is no budgetary entry, and the proprietary journal entry will be program cost, material debit, and operating materials and supplies held for use credit, to record material used. Now, in transaction number G, the agency recorded a commitment for 4,000 for materials and placed a purchase order for the same amount but did not receive delivery of the materials by year end. So there will be two budgetary journal entries. First, the agency commits the funds, and the journal entry will be allotment realized resources debit and commitments credit by 4,000. The second journal entry will be to obligate funds for materials ordered, and the budgetary journal entry will be commitments debit, undelivered orders obligations unpaid credit by 4,000 to obligate funds for materials used. You can see that there are no proprietary journal entries at the time the agency commits funds. Next, let us see how to record transactions for salaries paid and accrued for federal government. Okay. So here are some basic journal entries for salaries paid and accrued for federal government. Uh, so, in the case of federal government, full-time equivalent personnels are reported in order to ensure that appropriate control is maintained both at the budget formulation stage and the execution stage. Salaries are recorded as obligations, and their recording is very similar to recording of acquisition of material except some minor changes. Like in case of acquisition of materials, commitment accounting is used to reserve budgetary authority. Uh, you can see over here we have used commitment accounting in the case of acquisition and use of materials. However, in case of salaries, resources will be used by the agency, but the request is to be made to the treasury and not to the external party. So, commitment accounting is not used, and the budgetary entry will be allotment realized resources debit and delivered orders obligations unpaid credit and not commitment to record use of resources for salaries. We will also record the proprietary entry. However, unlike materials where we debit accounts payable, we will debit program cost salaries and credit disbursements in transit to record request to treasury for checks. And the proprietary journal entry you can see over here is program cost salaries is debit and disbursement cost in transit is credit. We will make one more proprietary entry for financing the salary cost, similar to the proprietary entry for financing of material purchased. You can see as the proprietary journal entry over here. And the journal entry will be the same operating materials and supplies held for use debit, and obviously it is not going to be accounts pay um, uh, sorry it will be unexpended appropriations used debit and expended appropriations credit to record financing of salary. So there is no difference as far as the recording of financing of salary cost is concerned. It is similar to financing of material purchased. And you can see over here we have unexpended appropriations used debit and expended appropriations credit. Next, The Treasury informed the agency that the salary of 85,000 is paid. So when the Treasury informs the agency that the payment has been made, the budgetary and proprietary journal entries will be recorded, and they will be similar to journal entries recorded to confirm payment of Treasury on acquisition of material. You can see it will be similar to what we have done in the case of material, and we will see that how they are recorded. So we have delivered orders obligations unpaid debit and delivered orders obligations paid credit to record confirm payment by treasury, and the proprietary journal entry will be disbursements in transit debit fund balance with treasury credit to record confirmed payment by the treasury. Okay. Then at year end, accrual is needed for 6,000 of unpaid salaries, and that resources have been budgeted for that purpose. So salary is accrued but not yet paid. So the journal entries for accrued salaries will be similar to salaries paid with very minor differences, like while recording budgetary entry, the journal entry will be the same except it will be salary accrual and not just salary. So the budgetary journal entry is allotment realized resources debit and delivered orders obligations unpaid credit to record use of resources for salary accrued. Now, since there will be no request to Treasury for checks, the proprietary journal entry will be program cost salaries debit and accrued funded payroll and not disbursement in transit to record accrual of year end payroll. And the journal entry to record financing of salary will be similar to salaries paid, except it will be again salary accrual and not just salary. Next, let us see how transactions are recorded for other types of expenses. So, we have salaries for, uh, other types of expenses. Now, the agency issues travel orders for 8,000. So, once again, the journal entry will be quite similar to acquisition and use of materials. Don't forget that there will be no commitment, and the budgetary entry to record issuance of travel orders will be the budgetary entry is allotment realized resources debit and undelivered orders obligations unpaid credit to record issuance of travel orders. Obviously, there will be no proprietary journal entry. Now, so that is transaction number A. And now in B, the travel is completed and a travel voucher for 9,000 is submitted and approved. And the entry will be the same as recording of acceptance of delivery of material, except that allotment realized will be debited to as additional resource of 1,000. You can see that they issued travel orders for 8,000, but they have submitted and this is approved for 9,000. So the allotment realized resources has to be debited by the difference of 1,000. So So while making the proprietary entry to record approved travel expenses, program cost travel expenses, will be debited in place of operating materials and supplies held for use. And the proprietary journal entry is program cost, travel expenses debit, and accounts payable credit by 9,000 to record approved travel expenses. There will be no change to record financing of travel expenses. Unexpended appropriation used is debit, and expended appropriation is credit by 9,000. So this completes the recording of budgetary and proprietary journal entries. Oh, there are few there are few year-end adjusting entries. Sorry for that. Um, year-end adjusting year-end adjusting entries, and uh, accrued vacation leave is 4,000. So just keep in mind that appropriations does include provision for the adjustment of year-end salary accrued, but not provision for accrued vacation leave. Since there is no budgetary resource for accrued vacation leave, there will be no budgetary entry or proprietary entry. However, to record accrual of unfunded leave, there will be a proprietary journal entry, and you can see there is no budgetary. The proprietary journal entry is future funded expenses debit, and unfunded leave is credit by 4,000. Uh, Next, depreciation on general plant, property, and equipment is to be recorded for 8,000. There will be no budgetary journal entry as the equipment was acquired with the previous year's budgetary resource. You can see over here, but depreciation is not a budgetary entry. There will be no proprietary entry to record the financing event as it was financed with the previous year's appropriation. So there will be no budgetary entry to record the depreciation of equipment, you can see. And the proprietary journal entry will be program cost, depreciation debit, and accumulated depreciation credit by 8,000. So we have recorded all the transactions. Next, all the journal entries and the adjusting entries are posted in the in the ledger so that we can prepare the pre-closing trial balance and the closing entries. Now, these are all the journal entries you can see, and um, all the journal entries are there. 1 2 3 4 and 5. We have there are 5 over here. 1 2 3 4 and 5. So all 5 have been recorded, and at this level of your learning, definitely you know how to post from the journal to the ledger. So for your convenience, I have put the budgetary account titles in red color, while the proprietary journal entries are in blue color. These are proprietary journal entries. I would just add two things over here that when you, 1 minute. Uh, this is the beginning balance for general property, plant, and equipment, and cumulative results of operation as it was stated in the illustration over here. So this is how the transactions will be posted in the ledger, and next we are going to prepare the pre-closing trial balance from the ledger balances. So you can see that These are all the ledger balances for the journal entries, both for budgetary and proprietary transactions we have recorded. So now we prepare the pre-closing trial balance from the ledger, and we have we have the pre-closing trial balance for budgetary accounts, and we have the pre-closing trial balance for the proprietary accounts. And this will be, what is the year? Year is 2023. It should be not 1323. Okay. So other appropriations realized is 150,000. As you can see over here, as I told you that all the budgetary accounts, I have put their title in red color for easy recognition, and you can see that other appropriation realized is debit by 150,000. Regarding unapportioned authority, you can see that there is no balance for the unapportioned authority, and that's why there nothing is written for the amount, and same is the case for apportionments as well. Then we look into the allotments realized resources, and allotment realized resources you can see are here, and they are 4,000. Then we have undelivered orders obligations unpaid, and they are undelivered orders obligations unpaid 4,000. Then we have delivered orders obligations unpaid, and they have a credit balance of 15,000. And finally, we have delivered orders obligations paid, and the balance is 127,000. You can see that there are no further budgetary accounts, and to verify, you can see that the total of debit is equal to the total of credit. That means we have solved the exercise mathematically correct. Next, we prepare the proprietary accounts, and we start with the fund balance with the treasury. And the fund balance with the treasury is 23. Fund balance with the treasury is 23,000. Then we have operating materials and supplies held for use, and we have operating supplies and materials held for use, debit balance of 7,000. Then we have general property, plant and equipment 40,000. That is what we have over here. Then we have accumulated depreciation, and accumulated depreciation is 8,000. Then we have accounts payable, and accounts payable is 9,000. Then we have accrued funded payroll of 6,000, and this is accrued funded payroll credit balance of 6,000. Then we have unfunded leave, and the unfunded leave is credit. They have a credit balance of 4,000. Then we have unexpended appropriations. Appropriations received for 150,000, and we have the credit balance for 150,000. Then we have unexpended appropriations used 142,000, and unexpended appropriations used is 142,000. Then we have the cumulative results of operation of 40,000. This is what we have in the beginning of 40,000. They have a credit balance. Next, we have expended appropriations of 142,000, and we have expended appropriations of 142,000. Then we have program cost material debit balance of 35,000. Then we have program cost salaries for 91,000. Then we have program cost travel expenses 9,000. Then we have fund program cost depreciation 8,000. And finally we have the future expended expenses of 4,000. Once again, the total of debit is equal to the credit. That means we have solved the exercise mathematically correct. Next, we will record the closing entries from the pre-closing trial balance. So the pre-closing trial balance is what we have over here. Pre-closing trial balance for the budgetary accounts, and there we have the pre-closing trial balance for the proprietary accounts. And obviously we are going to take the help of these pre-closing trial balance to record the closing journal entries. Now you can see that the accounts undelivered orders obligations uh, uh, are unpaid, and delivered orders obligations unpaid 15,000. These will not be closed at this moment as payments are not yet made. So first, the expired appropriation budgetary account will be closed, and the closing entry will be allotment realized resources debit by 4,000. And you can see the this is allotment realized resources is credit. So obviously to close we have debited allotment realized resources is debit by 4,000, and allotments expired authority is credit by 4,000. Next we will close the expended appropriations and establish collected resource account. So the total in this account you can see is 23,000, um, and this total of 23,000 equals the total of the allotments expired authority of 4,000, that is allotment realized resources of 4,000, and the unpaid obligations account of, these are the two unpaid, 15 plus 4, that is 19. 19 plus 4 is 23,000, and they are credit, so obviously we have to debit them to close them. Next, we are going to close the proprietary accounts, and we will close the financing sources and program cost accounts to the net position account as cumulative result of operations. And I will explain you in a minute. So the two unexpended appropriation accounts received and reused are closed to a single net position account captioned unexpended appropriations used, and I will explain you this part as well. Okay, so first of all, we have expended appropriations, and expended appropriations is 142,000 credit, so we have to debit it. Then we have the program cost material debit. To close it we have credited. Program cost salaries is 91. Then we have program cost travel expenses 9,000. Then we have program cost depreciation 8,000, and we have future funded expenses debit, we have credited here for 4,000. Now you can see that the total of credit is 147,000. So the balancing figure 142 minus 147 minus 142 is the cumulative result of operation 5000. At the same time, we have unexpended appropriations received, and that is 150,000. 150,000 credit, that's why we have debited it. And the unexpended appropriations used is 142,000 debit. To close, we have credit, and the balance of 8,000 is recorded as unexpended appropriations. So that's how we are going to close the budgetary and proprietary accounts. And finally, we are going to prepare the balance sheet. And again, we are going to use the pre-closing trial balance for budgetary accounts and the proprietary accounts, and let us see how we have closed that. So first of all, we have the assets, and among the assets, we have the intra-governmental fund balance with the treasury, and the fund balance with the treasury is 23,000 as it is in the proprietary accounts. Then we have the operating material and supplies used held for use, that is 7,000, and we have 7,000 over here. Then we have general property, plant and equipment 40,000. We have general property, plant and equipment, and from this we are going to subtract the accumulated depreciation. So this is the net value 32,000, and the total for the assets is 62,000. Then you can see that we will look into the liabilities. We have accounts payable of 9,000. Then we have accrued funded payroll of 6,000, unfunded leave of 4,000. So these are our total liabilities. Then, if you can remember, we have unexpended appropriations of 18,000, and this 8,000, and this 8,000 is recorded over here. Now, another thing I would like to notice is look at the cumulative results of operation. We have a total of 35,000, and let me show you how this happens. You can see that before the closing entry, the cumulative result of operation had a credit balance of 40,000, and then when we were making the closing entry, we have cumulative results operation debit by 5,000. So when it is debit, so now we have a credit balance of 35,000, and that is what is recorded over here. So the total of the two, the total net position is 43, and you can see that the total of liabilities and net position is equal to the total of net assets. So what you can see that when we prepare the balance sheet, obviously we are not going to use any information from the pre-closing trial balance for budgetary accounts. We only take the pre-closing trial balance values of the proprietary accounts. So this completes the second video on federal government accounting and financial reporting. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.